On December 5, 2025, Greggs, the UK's beloved food-to-go chain, landed in the financial spotlight. The company, known for its iconic blue and orange branding, suddenly found itself at the center of attention, not just from loyal customers, but from the world's top investors.
The catalyst. JPMorgan, one of the world's largest and most influential investment banks, initiated coverage with a bullish overweight rating. This move signaled strong confidence in Greggs' future growth and profitability, catching the eye of the entire financial community.
The market responded instantly. Greggs' stock price surged over 5% in a single day. Investors rushed to buy shares, eager not to miss out on what could be a major growth story in the UK retail sector.
For many Brits, Greggs is more than a stock. It's a daily staple, famous for affordable sausage rolls and sweet treats. The brand has become woven into the fabric of British life, with its products enjoyed by millions every week.
Its widespread popularity and loyal customer base are key to its business success. Greggs' ability to attract repeat customers, even during tough economic times, sets it apart from many competitors.
The JPMorgan upgrade is especially notable amid mixed sentiment for the UK economy. With uncertainty in the market, a vote of confidence from such a major bank carries extra weight.
With consumers feeling the pinch, Greggs' value proposition stands out even more. Its affordable menu and convenient locations make it a go-to choice for people looking to save money without sacrificing quality.
The bank's analysis highlights Greggs as not just a popular food retailer, but a robust financial performer. Its consistent growth and resilience have made it a standout in the sector.
In this video, we'll break down JPMorgan's optimistic forecast, exploring the reasons behind their positive outlook and what it could mean for investors. We'll explain what an overweight rating means and why it's significant when it comes from a powerhouse like JPMorgan. Plus, we'll look at why Greggs' business model is so effective, from its product innovation to its efficient operations and customer loyalty. We'll also explore the company's recent share price, its ambitious expansion plans, and how it's positioning itself for future growth in a competitive market. And finally, we'll discuss why JPMorgan sees Greggs as a compelling investment opportunity, and what this could mean for the future of the UK's favorite bakery chain.
When JPMorgan rates a stock, it's giving a professional opinion on its future performance.
An overweight rating signals the bank expects Greggs shares to outperform the market over the next 6 to 12 months.
This attracts attention from big investors who may have been waiting for a credible endorsement. The detailed research report justifies this positive outlook, covering sales trends and management strategy. It's not a guarantee, but a forecast based on deep research and financial modeling. JPMorgan's analysts believe Greggs offers a better-than-average opportunity for growth in food retail. They set a price target of £2,110 by December 2027, about 35% above the current price. This clear, quantifiable prediction adds weight to the overweight rating and gives investors a sense of the opportunity ahead.
JPMorgan's optimism is rooted in Greggs' efficient, profitable business model.
Greggs controls much of its supply chain, producing bestsellers like sausage rolls in-house.
This vertical integration keeps costs down and quality consistent.
The result? Greggs achieved a gross margin of 61.7% in 2024, nearly double the industry average.
High margins give Greggs a cushion to absorb rising costs and invest in growth.
Store-level efficiency is another strength. Sales density is among the highest in UK food retail.
Each store is a productive asset, trailing only discount giants like Aldi.
Greggs also boasts a sector-leading return on invested capital of over 20%.
Whether opening new stores or investing in tech, Greggs generates high returns.
This combination of high margins, efficiency, and smart capital allocation makes Greggs a structural winner.
Despite JPMorgan's positive outlook, Greggs' shares had dropped 40% in 2025 before the upgrade. The UK's tough economic climate and high investment spending made investors cautious. Heavy capital expenditure temporarily reduced free cash flow, spooking the market. But JPMorgan saw a disconnect. While the share price fell 40%, profit forecasts only dropped 15%. The market's reaction was overly pessimistic, creating a potential buying opportunity. Investors focused on short-term pressures, overlooking the long-term benefits of Greg's investments. JPMorgan argues the underlying business remains strong, with resilient sales and robust margins. The sell-off was more about market fears than company weakness. This valuation reset pushed the stock below its true long-term value.
Understanding this context is key to seeing why JPMorgan believes Greg's is undervalued. After the sharp share price drop, JPMorgan argues Greg's is now significantly undervalued.
Key valuation metrics, like PE and EV/EBITDA, are at a 40% discount to their 10-year averages. This is rare for a fundamentally sound business. Value investors look for strong companies temporarily out of favor. Greg's fits the bill. The market is fixated on short-term costs, missing the long-term benefits of expansion. Once the investment phase ends, Greg's true earnings power will shine. JPMorgan's overweight rating is based on the belief that this valuation gap will close as the market recognizes Greg's strengths. As profits improve, the share price could rise significantly, rewarding patient investors.
JPMorgan's thesis hinges on Greg's bold growth strategy.
The company is investing $300 million in 2025, mainly in 2 new distribution centers.
These facilities will support a target of 3,000 stores by 2030, up from 2,618 today.
There's still plenty of room for expansion, especially in travel hubs and underserved towns.
Greg's is also extending trading hours and targeting the evening market, which now accounts for over 9% of sales.
This boosts revenue without the cost of new locations.
Digital and delivery channels are another focus, with partnerships like Just Eat and Click and Collect.
This multi-channel approach meets modern consumer habits and opens new sales opportunities.
JPMorgan sees these initiatives, more stores, longer hours, digital expansion, as powerful drivers of future growth.
Together, they position Greg's for sustained sales momentum.
JPMorgan's latest report forecasts steady, reliable growth for Greg's over the coming years, highlighting the company's resilience in a competitive market.
Like-for-like sales are projected to rise 2.3% in 2025 and 2.5% in 2026, with growth expected to accelerate further to between 3 and 3.5% in the years that follow. This consistent sales momentum reflects both strong customer demand and Greg's ability to adapt to changing consumer preferences. The opening of hundreds of new stores across the UK will be a key driver, pushing total sales even higher and expanding Greg's footprint into new communities. EBIT margins, which measure operating profitability, are expected to recover from 8.4% in 2025 to 8.5% in 2027 and could approach an impressive 9.8% by 2030 as efficiency initiatives and scale benefits kick in. Earnings per share could double from 117p in 2025 to 237p by 2032, reflecting not just higher sales but also improved profitability and disciplined cost management.
The catch? Heavy investment in new stores and infrastructure means negative free cash flow in 2025, about $64 million. This upfront spending is necessary to support future growth.
But this negative cash flow is only temporary. As major projects are completed, capital expenditures will fall and free cash flow will rebound strongly. By 2027, free cash flow is forecast to hit $109 million, rising steadily to $228 million by 2032, providing a solid financial foundation for the company. This future cash generation will enable Greg's to pay attractive dividends, reduce debt, or reinvest in even more growth opportunities, giving management flexibility.
The short-term pain of negative cash flow is the price for long-term gain, as these investments lay the groundwork for sustainable expansion.
That's what makes Greg's story so compelling for long-term investors. Despite short-term challenges, the company's growth prospects and financial discipline point to a bright future.
No investment is risk-free, and JPMorgan highlights key challenges.
Execution risk is real. Delays or cost overruns in new facilities could hurt growth.
Economic downturns could also impact even value-focused brands like Greg's.
Competition is fierce, and failure to innovate could erode market share.
Despite these risks, JPMorgan sees the potential rewards as much greater than the risks.
Their base case is a 35% upside to 2,110p if Greggs executes well.
In a bull case, the stock could rise 53% to 2,430p. In a bear case, it could fall 16% to 1,340p.
The potential gain is more than 3 times the potential loss.
That's why JPMorgan calls Greggs an asymmetric bet for investors.
In summary, JPMorgan's overweight rating on Greggs is built on a detailed, optimistic thesis. The bank's analysts see Greggs as a standout in the UK retail sector, with a business model that's both resilient and adaptable. Their research highlights not just current strengths, but also the company's ability to navigate changing consumer trends and economic cycles.
The 40% share price drop in 2025 has created a rare chance to buy a market leader at a discount. For investors seeking value, this kind of opportunity doesn't come around often. It's a moment when short-term market fears have overshadowed the company's long-term strengths, opening the door for those willing to look beyond the headlines.
Greggs' vertically integrated model delivers industry-leading margins and efficiency. By controlling its supply chain from bakery to storefront, Greggs can keep costs low and quality high, even as competitors struggle with inflation and supply disruptions.
High returns on invested capital and strong store productivity set it apart. Each new location quickly becomes profitable, and existing stores continue to outperform peers, reinforcing Greggs' reputation for operational excellence.
The company is investing now to secure future growth, new distribution centers, more stores, and digital expansion. These strategic moves are designed to capture new markets and meet evolving customer needs, ensuring Greggs stays ahead of the curve.
These moves will drive sales and profits for years to come. As Greggs expands its footprint and leverages technology, it's poised to benefit from both increased scale and deeper customer engagement.
While short-term cash flow will dip, projections show a strong rebound after 2026. This temporary setback is part of a larger growth story, with analysts expecting robust financial health as investments begin to pay off.
Risks exist, but the upside far outweighs the downside. With a proven management team and a clear strategy, Greggs is well positioned to overcome challenges and deliver for shareholders.
JPMorgan's 2,110p price target suggests a 35% return as the market recognizes Greggs' long-term potential. This target reflects confidence in the company's ability to execute and grow, even in a competitive landscape.
For patient investors, Greggs could be a resilient British success story at a bargain price. With strong fundamentals and a clear path to growth, it stands out as a structural winner in the making.